Welcome back to the TD Ameritrade Network. We're talking markets. We got the panel here for us. Alan Uckman has joined, the Chief Market Strategist at Agora Financial. Alan, great to have you back.
Good afternoon.
I was joking. I kind of take advantage of you here, Alan, because you can just jump around, so we don't have to, plan as much. We also got Scott Connor, of course, the host of Virtual Trade, and Nick Theodorakis, Financial Risk Management Director at TD. You want to talk some more banks?
Well, I want to finish on that subject
group.
that it's not what you trade, but it's how you trade. So it's about having the discipline. So it doesn't really matter. So it's good
me and Tom's
conversation piece.
From the options corner?
Yeah.
Okay. So basically hedging out your risk.
So you can trade any market, any direction, any time, especially with technology and the platforms the way they are now. Things are much different than when we were little traders. Remember how you had limited opportunity. You had what you had in front of you, and if it wasn't there, it wasn't there. You couldn't make you couldn't force trades.
So for stock like Morgan Stanley that we were talking about, I'll bet I didn't even realize just how ugly the chart for Morgan Stanley looks on a holistic basis. On a day-to-day, we know that now they've been getting pummeled with this close to, on the short-term inversion of the yield curve, and now the rally in bonds. This is nobody thought this was the 2018 chart for Morgan Stanley.
That's
this
ugly.
is
But if you back it out, we've dropped from 60 down to 40, but if you back it out, that 40 looks like a pretty interesting level to keep an eye on. So if you can think not tomorrow, not next week, but you can go out and get some June options, you can look and try and look for a bottom here.
I
see where it broke out of 40 at 2016.
That was the election.
So that should act as a support point. So this might be an opportunity here. And you talked about the banks. What we've seen here in a lot of these banks, bullish divergence, new one-year lows, but not new highs in volatility. That to me is a sign that the shorts are about done with their selling.
It's that $40 levels, we saw that.
Now you like it, don't you?
That pop, well, I don't like anything now. I just analyze it. That pop that we're just looking at, bring up the chart again, that 2016, that's the Trump election. That was the inflationary trade, the so-called Trump trade, basically. There's going to be spending, yields will go up. Banks will have deregulated environment. Now, we could argue till our breath is out about how much of that we got, how much we didn't. We definitely got some of it, especially on the deregulatory side. Yields are apparently still up for debate. So, Nick, we've basically given back the entire bank rally post-election. That's almost a seminal moment in my mind, to be honest.
Yeah, even I can do this math, right? 3 years ago, Morgan Stanley was trading 20, now it's trading 40, it traded 60 in the middle, right? So we're halfway back down. The Trump election for these banks, particularly the big investment banks, was real and very big. And if you listen to the comments coming out, regulation has eased, right? So I think if we get a stabilizing interest rate environment, then we could see this rally back. I kind of tend to agree with what Alan said. This could be a longer term play. I think when you look at some of the larger multinational banks, you look to Europe right now, you look at what's going on in Germany and in Italy and in France for different reasons. There's a lot of scary stuff affecting these international banks. I know hard to access them here. We don't trade them directly, but there's a lot going on in those markets, and there is some comments now about a contagion effect if things go south in Italy. How could that really start to flow through the banking system? I think you're seeing some of that being priced into this.
But Alan, you're not a big how or why guy. You're a what's happening, what am I going to do about it type of guy.
I'm going to do it to you again. I'm going to ask you to pull the chart out. Let's go back to 2008, 2009.
Love it.
And go even further.
Calling for charts.
Go even further, and you'll see that this bank rally is not new. It wasn't just because of Trump. Obviously, we bought it out after the.
But that gap there, come on, that was a big gap.
That was an acceleration. That was kind of a blow off top. Now we're coming back to more the normalization of the overall trend. And so I think that you can see that was just a little bit of a bump.
15-year chart.
But let's look at the fact that it's had a healthy rally from the bottom. And the PE ratio right now, Morgan Stanley's 8. A June option has 7 months of time. This 40 level is important to lean on a monthly basis. So there may be some value here at these levels.
And volatility is not through the roof in these financials.
No, right, not at all.
So you're right. I thought my 3-year chart had you, but you go back 15. That's a different. But
screw it, bring up a 40-year chart.
Further. But you look at the vol, and they're not crazy. They're not predicting some crash out here.
No, that's where you start with anything. You start with the PE ratio. Where is it relative to what that PE ratio is? 8, a single-digit PE ratio. It's hard to argue a stock is overvalued. But I think if you look back over the last year, right, and you say what caused this run up to 40 and then to 60? Well, going into that, and the Trump election was what? It was two things. Favorable tax, corporate tax.
Favorable regulation.
Favorable, and deregulation. That was probably the biggest thing. So the anticipated rally was on those two things. Then what happened? Then we started getting higher interest rates, a more aggressive Fed, which should be potentially better for banks as well. So you had sort of the perfect storm in favor of them. What's happened recently? Well, some of that fervor on the interest rate side has subsided a little bit, right? So you have that happening. Then you have some negative publicity. But I thought what was interesting today is when Yellen came out today. I don't know if you guys read this today. She came out and said she was almost on the predicting financial bubble side.
Right.
And basically because of the regulations,
Scott,
the
Connor,
relaxing
you're
regulations.
blowing the cut the cord theme,
Oh,
man.
I don't know if I'm doing it.
I'm just kidding.
But
No,
as an investor, this is what you have to think about.
And it was a huge point because everybody apparently the past couple of weeks is
Right.
wants a dovish Fed because they're concerned the economy might be too slow. She's still on the other side, basically kind of coming to Powell's back in a way and going, look, the actual risk here is that we might still overheat.
Yeah, and like I said, especially from the regulation side. She's afraid that the regulations swung too far to the other side. So, again, there's a lot of factors.
I think it's the whole group. Look at XLF itself.
Yeah.
I mean, if you don't want to pick an
She's talking
individual
about
stock,
financials general.
just look at XLF and you can lean on that 20 level, very significant support on that chart there.
Do you trade? I'm curious on the technical side. Do you think about the ETF sort of in the same way that you would if it were just a single stock? Do you look at the same types of patterns, the same types of inputs?
Exactly the same thing. I'm not smart enough to digest all the news and all the intricacies. I'm just looking at the price and looking at that chart. If I can't pick a specific bank, this is a good way to play it. You can look at a 2020 January call, a $20 call, and your break-even's about 75 cents away. If you're buying an in-the-money call as a stock substitution strategy, looking for this to hold that 20 level. So that's how I position myself for the long term. Try and make it very simple, try and buy more time than I need, and just lean on levels, and we're in a bull market until proven otherwise.
Nick, let's to bring the fundamental side into it again. I like this kind of going back and forth between the chart and the fundamental side, because if you're looking for the time, if you're an investor that wants to go, hey, I want exposure to this, but I'm not sure I want to jump in front of the train that is that chart right now that year to date just keeps making new lows. For Morgan Stanley, it's been cheap for a long time. The PE and the price to book actually is what a lot of the fundamental investors will use for a bank. They've been notoriously cheap relative to history for like a year, and it hasn't helped the stock price yet. So what's it going to be? Is it going to be some event where suddenly the banks demonstrate their value again to do, I don't know, maybe act as a backstop to the economy? Is it going to be volatility we're experiencing to help the ones with heavy trading desks? Help me think about this.
It's a really hard question to answer. I mean, you guys hit the numbers. I won't I claim to know something that's not in there, but I think if we see more relaxing regulation and a widening yield curve, those have to be the catalyst to drive this higher. But I agree. I think they look really cheap relative, both in terms of volatility and absolute price. And I don't believe that with all the shadow banking and lots of stuff out there, these companies, particularly, Morgan Stanley just got a bid to do the Uber IPO, right? They're going to be the lead on that. Like, there's real business that has to be conducted, and that's still going to happen. So I don't know to your point.
They could be making more money
in
this environment. You take a look at Morgan Stanley. They made $2 billion last quarter in pure profit for the quarter. So a quarter like this is when the guys make their money. This is when the pros.
They love VIX 22, right?
They're cashing in. They're cashing in right now.
Especially Morgan, because they actually, when everybody else was winding down, they kind of took a lot of that flow. Morgan has a notoriously on the street, very strong equity trading business. Suddenly you get a little VIX there, they might have an almost disproportionate.
Those numbers could.
Let's not cry for the bank's profits. Right. They've done very well. They've made record profits year after year after year for the last 3 years in a row. All-time record forever profits. So I mean, I know we like to talk about the regulation relaxation, but that has nothing to do with it.
We're crying for the investors.
That's psychological. That's just psychological.
Yeah, Scott, last thought on this?
No, I think everything we put together here is something you have to consider if you're looking at a group like this. You always want to look at fundamentals. You want to look at technicals. And keep an eye on what the market sort of tenor is, and look for things like when Yellen comes out and says something like that. But when you read that article, you've got to put it.
You think that's what pushed rates up today?
I think that's part of why we had such a tough week this week. If you look at the XLF, that fall off the last 5 days is incredibly steep compared to the action we've seen on the downside. Yes, it's been in a downtrend, but it got really steep these last 5 days. So a lot of people are scratching their heads saying, okay, what's the impetus behind this? And again, the yield curve might be part of it because that got a lot of headlines. But I think when something comes from a former Fed chairperson, people tend to
don't discount the international stuff here. I think there's a sentiment.
Deutsche Bank, Credit Suisse, they all look equally as bad.
It looks like it started there.
Kevin brought up the idea that which is a good one because a lot of times we think about them moving almost inversely to rates, but you have to kind of, there's a short term and a long term, right? Where if the TNX chart, yeah, there's a little bit of an upward move in yield today, but I mean, it's just a dot basically compared to the
still
rally
down
we've
in
had.
that 280 level, which is a significant support level. And it wasn't so long ago we were very concerned about rates rising on the 10-year. Now we're very concerned that rates have gone down. Yeah. So which one is it? You can't have it both ways.
That's a perfect segue into the next segment after we take a short break. We got about 1 minute. We'll be back with Alan Nuckman. After the break, the closers panel is going to figure out what happened if stocks end up in the red. NASDAQ is holding on for dear life in the next 60 seconds. Stick around.